which is why I support these tariffs for now, because I want this system to end and I know the tariffs will destroy it.
You want to get nuts? Let's get nuts.
Well, hello there, my friends. Rafi here from the Endgame Investor with this week's Silver Report for the Endgame Investor, sponsored by Kootenay Silver, symbol KOOYF in the US and symbol KTN in Canada. It's really hard to plan these things anymore. I do them once a week, the Silver Report, but you can't plan it because everything changes so radically every day that I got to do it on the fly. And I can publish it, but here's what happened today, what's going to happen tomorrow, what's going to happen over the weekend.
Prepare to fast forward!
Preparing to fast forward.
Fast forward!
Fast forwarding, sir.
Nobody knows. Everything is crazy. But what we know from this week is that, first of all, gold likely bottomed here. Probably silver too. Why? Because silver follows gold more or less. We're going to talk about the gold to silver ratio, which is again above 100 to 1 for only the fifth time in recorded history. And the first time was in 1934, I think, with the revaluation of gold. But anyway, gold most likely bottomed because of the open interest numbers that are now below 450,000 contracts. And I'll show you a graph that shows that at these numbers, lows have almost always been hit. We're also going to talk about the gold to S&P 500 ratio, or the S&P 500 to gold ratio, which is now at 1.77. The trend line has been broken, decisively, and we are now on the way down. In this ratio, the 2011 level was about 0.6. We're going to head back down there. Notice that as the stock market has been crashing and climbing by 10%, 11%, 15% for tech stocks yesterday, gold has been relatively calm compared to that, even though it too has been rocking back and forth. It has not been rocking back and forth nearly as hard as stocks have, and that is why we hold it. One of the reasons, at least. The Bitcoin to gold ratio has hit its trend line from 2023 for the third time. If it breaks this, Bitcoin is going to fall hard versus gold. I expect that to happen any day now. The gold to silver ratio is above 100 for only the fifth time in history. I'm looking at the chart now, 1934, 1943, 1991, 2020, and now. And that's it. You're not going to get a much better price on silver relative to gold if you want to maximize your gold holdings. And we do hit a 15 to 1 ratio, and I expect that we will at some point during the end game at the bell ringing at the end game top. Then you can accumulate 7 times as more gold with silver now than you can with gold itself. I don't recommend holding only silver. I don't recommend holding only gold. I don't recommend anything really. I myself hold a mix that helps me sleep the latest at night. Gold for after the end game and silver only to get through the end game itself. And finally, we're going to talk about the plumbing, which is going a little bit nuts.
You want to get nuts? Let's get nuts.
The secured overnight financing rate, aka the repo rate, is wobbling like it's never wobbled before. Not even before the repocalypse has it ever wobbled with such volatility. I'll show you the chart there, and it should scare you if you know anything about financial plumbing, which if you're a plumber, you probably know about. And the last thing we'll talk about is why the tariffs cannot succeed, not even theoretically, because if they do, that means all the dollars from accumulated trade deficits from 1971 and beyond come back to the United States, and we export stuff, meaning we, meaning the United States. And the United States exports stuff, meaning has less stuff and more dollars, which means higher interest rates, more dollars, less stuff, higher prices. And that is the key to hyperinflation. Anyway, let's continue with this week's Silver Report, brought to you by Kootenay Silver. When I say this a little bit tongue-in-cheek about Kootenay Silver, KOOYF in the United States and KTN in Canada, its price action does not really seem to care about tariffs so much. This is to be expected because either Kootenay will succeed in offloading its assets, developing and then offloading its assets, or it won't. and it doesn't have anything to do with the macro picture. It has very little to do. Silver explorers are certainly not my core holding for the end game, and I don't consider this really end game prep that much, though. If silver does approach the 15-to-1 ratio, these companies are going to look a lot more attractive to potential buyers who are going to want to mine as much silver as they can. And once their assets are offloaded, I do expect it to be some kind of an equity deal, and eventually for shareholders to get a piece of dividends, which after the end game, I'm sure that mining companies are going to pay out in order to keep people to continue to hold their stocks long term. We have here a table of the drill results from the Columba project, which is its main project now. This is in its investor presentation, and it will be in a link in the description below to check out all the details for those geologists around us. Check out these numbers. You can see the bold are highlighted. This is grams per ton of silver per hole and the width of the hole. This one is 9,840 grams per ton, which is almost 10 kilograms per ton of ore. There are many in the thousands of grams per ton. It goes on for 8 pages. You can see the full results here, what they have developed in this resource so far. And they have it more organized with the highlights over here. Some of these in the thousands. You can see 1,915 grams per ton, 1,765, 2,500 almost over here. And here's 5,840 grams per ton on the bet that as the gold to silver ratio drops, and it certainly will drop from the 100-to-1 ratio it is now, these properties are going to look very attractive for a major mining company. And with that, let's continue with this week's Silver Report brought to you by Kootenay Silver. The first shot I wanted to show you today is something I shared on the Endgame Investor on Substack. You can see here, the black line over here is the amount of open interest, the number of contracts open in the gold futures market. I drew the line over here so you can see when we have hit around this line. This has been 1, 2, 3, 4, 5, 6, 7, 8 times since 2021. Each time we've been around this number, maybe slightly below it. Sometimes we've hit a local low or an intermediate low, some people call it, in the gold price. So if you had bought it any time when open interest was this low, now below 450,000 contracts, you would have been in very good shape. You'd, of course, been in very good shape no matter where you bought gold since 2021. But if you bought at these open interest numbers where we are now, but below 450,000 contracts, you would have been in very good shape. So the fact that so many contracts have closed since this crash, quote unquote, in gold, actually much less of a crash relative to stocks and relative to Bitcoin. This is probably a good place to add to your stacks. This is not a recommendation because I don't recommend anything. The next chart I have for you here is the S&P 500 to gold ratio. The lower it goes, the more expensive gold is relative to stocks. The cheaper stocks are relative to gold. You can see we still have a very long way to go to get to the 2011 lows of about 0.6 here. I drew 2 trend lines so you can see what happens when a trend line like this breaks. Last time a trend line like this broke was in 2018, and you can see that stocks got a lot cheaper relative to gold going into 2020. That was the low from the panic here. We're headed back into it, and I think we're going to break it this time. That level is about 1.4. Once we break that number, we're probably in the clear to just head down towards the 2011 low, and we're going to go beyond that, I'm sure, as the end game gets more intense. The Bitcoin to gold trend line, that hits again. This intermediate trend line from 2023, it has hit 1, 2, 3 times. This is the 3rd time. The hit is at around 25. It hit in a wick, on a bottom wick here. Here's the candle. We're just above it in the candle. I do think this trend line is going to break imminently. When it does, this trend from 2023, the end of the last crypto winter, to about 40 ounces per Bitcoin. We're now about close to half that. I think the record was like 41 or 42. I think we're about half that now. So the price of Bitcoin has been halved relative to gold as gold heads up steadily. Bitcoin wigs and wags, and whatever it does, zigs and zags, and it's crazy, and it's not a real good end game asset because it will make you not be able to sleep. Gold to silver above 100. This is the long-term since 1900 gold to silver ratio. You can see that these numbers, 100 to 1, I think we're 101, 102, something like that. These only happen during times of crisis. The gold revaluation of 1934, 1933, 1934, that was when gold was revalued from 21 to 35, and silver had to catch up. It did very quickly. This is the World War II low in silver relative to gold. And from there, we headed into the 1968, what was it, the death of the London gold pool, the breaking up of the London gold pool into 1968, back to a 15-to-1 ratio. Again, very close to 15-to-1 ratio in 1980. We hit that 3 times. We're going to hit it again. We hit the 100-to-1 ratio in 1991 for some reason. I thought it was Desert Storm, but it actually happened after the invasion of Iraq and Desert Storm. So I put I don't know here. I don't know what was causing the gold to silver ratio go to 100-to-1 back then.
I don't know.
Lighten up!
Lockdowns 2020, we know why that was, because the world was shutting down and so was industry, and silver was trading as an industrial commodity. So here we're at 100-to-1 again. This is a sign of serious financial stress, and we're in it now, folks. We are in it. You're not going to get much of a better price for silver relative to gold. So take that into consideration. This is the SOFR, Secured Overnight Financing Rate. This is the plumbing rate. This is the biggest pipe in the financial plumbing world, or the financial sewers. This is where about $2.6 trillion are trading hands every night in exchange for treasuries. You can see this rate is supposed to be rock solid. It's supposed to barely wiggle, and it barely wiggled throughout 2023 as they were raising rates. Basically, raising rates is like raising where the pipe is. The pipe is over here, the pipe is over here, another 25 basis points up. And when rates were about 5.3%, it was still pretty stable. It got a little bit more wobbly over here. I put the red here. You can see a little bit more wobbles over here as they start to cut rates. And now it's getting very, very wobbly. We are now at 4.42, and it should be around 4.33. It's wobbling about 10 to 12 basis points, sometimes 8 basis points a night now. This is signs of severe financial stress in the biggest pipes of the global monetary system, and it's going to break very soon. This is a joke that I'm putting together on authors of an article on Bloomberg, 2 authors and 2 graphic artists. All of them are women, an Indian, an American, a Chinese, I think, and an Arab. I'm not sure if she's Arab, but she has an Arab name. So, I'm just saying that. And why am I putting this out? Because it's fun. They walk into a finance bar, and doesn't that one on the left, the Indian, doesn't she look like that scene from True Lies when Jamie Lee Curtis is like in that dress? Anyway, here's what those women write. How much tariff turmoil until the Fed intervenes? 5 market crises provide clues. You can see all their lovely names: Jill R. Shah, Alex Harris, Dini Slew, and Raida Wahid. U.S. financial conditions have already deteriorated to the worst since May 2020, according to a Bloomberg index, which uses various indicators to track the overall level of financial stress in the country's money, bond, and equity markets. At Deutsche Bank AG, strategist George Saravelos told clients on Wednesday that if disruption in the U.S. Treasury market continues, we see no other option for the Fed but to step in with emergency purchases of U.S. Treasuries to stabilize the bond market. Ladies and gentlemen, this is absolutely going to happen. Whether it happens tomorrow or next week or a few weeks from now or a month or 2 from now makes no difference at all. It is absolutely going to happen. When it does, that is the final printing round beginning. Once it does, gold and silver are going to start to moonshot. You could say that gold has already been doing that. Silver definitely has not. Silver is going to wait for the final stages of the end game. It's going to rise in the final months of the end game, just as it did in 1979 to 1980, at the end of the 70s inflationary period that began in 1971. Only in the final months did silver really start to climb. Finally, why tariffs and balanced trade mean hyperinflation and rising rates. I am not against the Trump administration. I do not have Trump derangement syndrome. I'm just pointing out that the whole idea of tariffs rescuing the American economy is ridiculous. For logical reasons, it is impossible for tariffs to do anything but bring on hyperinflation, especially if theoretically they succeed. Why is that? Let's go through the bullet points. First, a trade imbalance means the U.S. exports more dollars and imports more stuff. So it's getting more stuff into the country and more dollars out of the country. Therefore, it has fewer dollars and more stuff, or for the price of that stuff in the country is lower than it otherwise would be. If all you have to do is print dollars to get stuff and you have the reserve currency of the planet, you are in pretty good shape. It is the trade imbalances that are keeping prices within the country controlled. That means, second bullet point, more stuff inside the US and fewer dollars. Third bullet point, countries with a trade surplus. What do they do with all those dollars? The United States exports dollars, which become part of the balance sheets of those other countries. What do they do with them? They buy treasuries with those dollars pushing rates down. They don't just hold the dollars. They buy US treasuries, they earn the interest, and that pushes bond rates down. That keeps the government's deficit financed because of the trade deficits that exist. Those are the only things that are saving the dollar, the trade deficits themselves. Next bullet point, reversal of trade deficits means those with a trade surplus must sell treasuries for dollars to buy US stuff. What do you buy US stuff with? Dollars. Where do you get dollars? You get them from the trade surpluses that you had in the past. So if you want balanced trade with these other countries, you're saying that you want the dollars back because you want to sell the United States stuff. You want to export it for dollars that you get back. So you have less stuff and more dollars. Next bullet point, rates go up because other countries that have until now had a trade surplus with the United States, they have to sell treasuries in order to raise dollars to import stuff from the United States to pay for that stuff in dollars. Rates go up, the US exports more stuff and imports more dollars, meaning more dollars and less stuff in the US. Therefore, final bullet point, rising rates and hyperinflation necessarily result. If you want balanced trade, balanced international trade, fine. But that means that all of the dollars that have been exported on net since the trade deficits began, they go back to the home country in exchange for stuff that the home country ships out. That causes the death of the dollar, the death of fiat currency, and the end of the fiat monetary system in its entirety, which is why I support these tariffs for now, because I want this system to end and I know the tariffs will destroy it. This is Rafi of the Endgame Investor with this week's Silver Report for the Endgame Investor, brought to you by Kootenay Silver, symbol KOOYF in the US and symbol KTN in Canada. And I'll see you guys next week, maybe, if tariffs haven't ended the dollar by then.
No, go past this part. In fact, never play this again.
Come on, let's get nuts.
You want to get nuts? Let's get nuts.